You're watching the Financial Sense News Hour, financial news for high net worth investors and strategists. When it comes to the biggest investment trends and understanding the market, we've been delivering the insights you need for over 30 years.
If you're looking at asset classes over the last decade, which performing asset class was the best? Well, if you're thinking of the NASDAQ, tech stocks, well, you might have been close. The NASDAQ is up 418%, the S&P up 268%. But the top performing asset class has been precious metals. Gold is up 428%, and silver is up 780%. Look at silver as the NASDAQ of precious metals. And that's what we're going to be discussing today. Joining me on the program is Bob Coleman from Idaho Armored Vaults and Dave Morgan from the Morgan Report. Guys, I want to start out with something that, and both of you can jump in and explain this, of how the futures market works and how the paper market controls much of what we see in the physical market. So let's begin with, let's say I'm a guy out of London. I got 1,000,000 ounces of gold in the registered category. I own the stuff, but I'm writing calls or selling gold into the futures market with the market in contango. Explain how that works and how these guys make money.
Sure, I can jump into that. The way the futures markets work basically is that you may have physical metal either in London, like you were mentioning, or you have that physical metal in the COMEX system, which is a group of depositories within a 150-mile range of Manhattan. And so ultimately what happens is with a contango, meaning the futures price, say 3 months out into the future or 6 months out into the future, that price is just a little bit higher than the current spot price in today's market. In certain conditions, it could be quite a bit higher, depending on the tightness and other factors. So what ends up happening is banks and institutions and so forth will use metals as a form of income. Not just simply a form of like long-term investment. So they'll take a physical position, they'll sell a futures contract against that at a higher price, and as that futures contract comes to maturity, that futures price then goes into par with the spot price, and then ultimately they close out that futures contract and they sell the next one forward. And so it's similar to writing covered calls, except in this instance, if the price gets too far away from you, meaning if the price goes up, you could have to be able, you may be forced to deliver that metal against that futures contract if you don't close the futures contract out.
So in a regular market, this is another way of earning income on a asset that doesn't earn income. So now let's take that same scenario, but I am selling gold or silver short. Explain how that works.
I can go ahead and jump in on that one, Jim.
Okay.
So this is how the COMEX actually works. Roughly step one, long and short remain open into the delivery month. So these contracts, and that's all they are, they're derivatives of gold and silver. So most contracts, over typically 95 to 99% of futures contracts are offset or rolled before first notice day. And that's historical. It's true of almost all commodities. So the notice of intention, a notice of intention is not a delivery. So the notice of intention to deliver, the short issues a notice of intent to deliver. This is what appears on the CME daily delivery report. And that's where I think these guys are going wrong. They're seeing that all the time. Most commentators call these deliveries. Technically, they are delivery notices. Think about a traffic ticket, notice to appear, you pay the ticket, you never appear. Assignment. The COMEX assigns the notice to a long. At this point, the long is obligated to pay. The short is obligated to deliver. The actual delivery. And here's the important part. Actual delivery occurs when payment is made and ownership of the warehouse warrant transfers, not the notice. Under CME rules, ownership transfers on delivery day after payment is completed. The metal usually does not move. The warrant changes ownership. The silver remains on the same shelf inside the same vault. For example, statistics. It could be 100 notices, but 2 deliveries. Once it gets to that point I just explained. So I think that what's important is to think about open interest and actual deliveries. Of all the open interest, once it gets down to put up or shut up, it drops to maybe 1 or 2%. So I think that's very important. Often it just stays in the warehouse. Transfer of ownership of the warehouse warrants uh, can move out of the warehouse. And that's what a lot of commentators continually dwell upon is that the COMEX is being drained. But I have a chart that I don't know if I can bring it up because my computer's not working properly, but I can send it to your staff after. And if you look at what happened during the tariff scare, the actual inventory in the COMEX was like at a record high. It hadn't been that high for a very, very long time. Most of that metal went from London to New York, from New York back to London. And when all that was said and done, that in and out took place and you got to the end result, still at that point, the total inventory on the COMEX in July 2026, as we're doing this interview, is a larger number than it was at the beginning of 2026, beginning of 2025, beginning of 2024, and beginning of 2023, which means there's more, not less. So if anyone says that the COMEX is being drained, I'd like them to show the COMEX inventory because that is fact. It's not fantasy.
So let me explain this. What I've seen the COMEX do in the past, and especially we saw it earlier in the year, when you see a huge run in either silver or gold, the COMEX will come in and start increasing margins as they do. I have never seen, and correct me if I'm wrong, they ever do that when you're shorting. I mean, you can short unlimited and there is no margin. Am I right on that?
That's actually incorrect. When they raise margin rates, I mean they're doing it for a couple different reasons. One is volatility has starting to go up to a point where that volatility is affecting clearing member firms both on the short side and the long side. So
Okay.
when they raise margins, when the CME raises margins, either on the COMEX or NYMEX contracts, which I've documented before, it affects both parties, and that ends up potentially squeezing actually the shorts because they're the ones that are at the biggest disadvantage. They're most in the debit at that moment as prices are going up, and so they get this squeeze effect that compounds also with the options market and other derivative markets where fast money comes into the market, starts impacting different types of option models and so forth, gamma squeezes, things like that. But it does impact the futures market because when they start raising those margins, now if you're short, you got to pony up even more money or you're forced to buy in and close the contract out.
Explain what happened in January where we had, I think somebody took delivery of silver on the COMEX. I think the figure was like 30, almost 34 million ounces. We saw silver that month go from 70 to its all-time high of 120. What was going on there?
Yeah, if to take a step back, you have to look at the silver market back in October of last year. That's when we saw silver break out to new all-time highs. It went through 50 for the first time and went to about 55. In October, what differentiated October from January is October, you actually had more of a physical squeeze, meaning the London markets were very tight on silver. They were actually needing the silver because so much money was going into the ETFs and so forth that there was a big demand for physical silver. So you started to see blowouts in contango and so forth on the futures market. Backwardation, meaning the spot price was more expensive than the futures price. And so it made sense to start moving a lot of metal out of New York and sending it over to London where it was more expensive. Basically, buying your metal in New York or buying back the short position, for example, and selling that physical metal in London and capturing that arbitrage or profit. Roll to January. What happened in January was not as much as a physical squeeze as people may imagine. It was more the options market became very impactful, meaning you had companies like Jane Street that took a 20 million plus position in SLV in the month of December. They went from, it was like a 20,000% increase in their share position from November into the end of December. And then they were using the options markets to game around that ETF position. So, and this is where Jane Street has been criticized in India as well as in the Bitcoin market, impacting spot prices or impacting prices of an underlying with the options market. And so that squeeze that happened in the options market, which compounded a lot of momentum money, it compounded a lot of gamma squeezing and so forth. Dealers got caught off guard. They had to buy in more collateral, meaning if they were short calls, for example, they had to buy the underlying SLV position or buy more calls themselves to protect against being short calls. That actually impacted the market much more than actually the physical market at that time.
So when we're looking at gold or silver at the market, you got to look at the futures market, what's going on there, shorts and the longs. But also you have to follow what's going on with the ETFs because they can be big drivers of the metal, as you just pointed out.
Yes, and with the ETFs, you have to understand the options markets and the structured product markets have just grown enormously. They've tripled in size over the last couple of years. So you have so much more leverage coming into any type of asset class, whether it's silver or commodities, oil, the stock market, individual stocks. This has become a bigger impact on whatever market is being sort of focused upon by these momentum traders.
So when I'm looking at the COMEX, as you pointed out, Dave, it's a little bit larger than it was at the beginning of the year. Because if you listen to some podcasts and you listen to some of the gold dealers, it's like there's none left.
I know it's rather frustrating, and I usually keep cool, calm, and collected. But one of the better known personalities on the web was basically calling out silver analysts not knowing what they're doing. My words, not his, but implying that the only thing they should be focused on is how badly the COMEX is being drained. And I had already contacted this individual and tried to explain what I just explained to the audience. And obviously, I did a very poor job because although he briefly mentioned he understood how the warrants exchanged hands, that we still had to see how badly the COMEX was being drained. And so I did an update using the CME data, which is if you're going to see the COMEX being drained, look at the COMEX. And just as a side note, I mean, I've been watching the inventory, both registered and eligible, for at least the 25 years I've been on the web at the Morgan Report. So do I look at it daily? No, I used to. I look at it usually once a week or once a month, but at least we get the ebb and flow. And metal does flow out of the COMEX, and not implying all the warrants change hand and all the metal stays on the shelves, although that is the vast majority. However, some metal does move out, but also some metal moves in. So I'll just leave it there, Jim.
Well, let's talk about if we're looking at the metals market, and I want to concentrate on silver now because unlike gold, silver is consumed. You're not going to uh, rehab a iPhone or put it through trying to get the silver content in your iPhone. But Dave, we've been running silver deficits of what, 200 million ounces a year. I think this is year number 6. So what's happening to above ground inventories and how long can you go on with those kind of deficits before it starts to impact the market? Because we're using silver in, you're looking at green technology, whether you're looking at windmills, solar panels, you're using it in industry, it's a key component. Talk about the inventory levels and then basic above ground inventory levels and then the deficits.
Absolutely. Uh, the only way to fairly or objectively look at, do we have a deficit or not is to check the above ground inventory. If it's expanding, obviously you don't have a deficit, you have quote unquote a surplus. If it's being depleted, obviously there's a deficit. We do have a deficit. That's been proven by almost everybody. There's one outfit that doesn't adhere to that, but they have a different metric or claim otherwise. So I want to go back in history because this is very important for what effect did it have. And I'm going to answer your question, Jim. But if you go back from 1990 to 2005 inclusive, we were in a deficit for 15 consecutive years. Now, the deficit varied year to year, but on aggregate, on the average, it was a 100 million ounce deficit over those 15 years, which is 1.5 billion ounces. So at the beginning of 1990, the above ground stockpile of silver, meaning commercial bar silver, was roughly 2 billion ounces. At the end of that 15-year period, we were down to 500 million ounces. And yet, in that time frame, the price of silver did not move very substantially at all. So what's the difference between 2005 and today? And I would say the difference is that there are a lot more people involved in the silver market. There's a lot more awareness of the debasement trade, and there's a lot more people that are watching the deficit, understand and realize if we had a 15-year deficit in soybean oil, in wheat, in cotton, in cocoa, in anything other than silver, I don't think you would have seen the ho-hum price action that we did see in silver from that period, 1990 to 2005. So this time it is different. I think it will have an effect. I think it's already in the pricing mechanism longer term. And last thing you didn't ask, but we might want to examine is now that it is a critical mineral per the U.S. government, I call it a strategic resource, which is what it used to be called. There could be a time when the government actually has to go in and buy, let's say, 100 million ounces for the strategic stockpile, which obviously add to physical demand of silver.
And I know, Dave, when you first introduced me to silver, it was back in the decade, and a lot of silver was used in film industry, obviously with digital cameras, our iPhones and things like that. It's less so. But isn't it, I think the figure is close to what, 65, 70% now is used in industry?
It depends on the study, but yeah, Jim, a very conservative number is 60%, and it's probably closer to 65. And if you go back again to that 1990 timeframe, we'll go back 25 years, just go back to the year 2000. The amount of silver in the industry was 35% of the market. And at that time, we mined 550 million ounces. Today, it's at least 60% of the market, and we mine 850 million ounces. So if you did the math on that and we only mine the same amount that we did 25 years ago, obviously we don't. But as a thought experiment, industry be eating up almost 100% of the market.
I want to go back now to coins themselves. Bob, you sell bullion. And we saw, I think, what was it, 24? We saw the premiums on silver eagles. I mean, some of these places were like 60, 80% premiums. What happened there? And I guess right now with the pullback in silver, silver's down about 50%, gold down 26. What are you seeing in the coin market? Are you seeing sellers, buyers? What are you seeing?
Yeah, I'll take the latter first. The issue that we're seeing, I think the industry is seeing, is really, yeah, selling coming back into the market. Maybe I think I've seen where it's 60%, 40%, meaning 60% of the transactions are sellbacks, 40% are maybe purchases. Now that the metals have gotten down to about 50, I think there are probably maybe more percentage of buyers than there are sellers. The public has certainly become worn out. I think you've seen that with a lack of interest in the market again, a lack of transactional volume. Transactional volume is way down from the last couple of years. Going back to 2000 to 2023, 2024 timeframe, when the premiums really blew out, this was a thing that I was really focused on and was on X and social media trying to explain how much the industry, being unregulated that it is, was taking advantage of the consumer. The industry was making no money in 2018 and 19. In fact, they were losing money. And then all of a sudden you had the COVID thing, you had plenty of money, and then you had a lot of people that had a lot of money in their pockets, and they started buying precious metals. Well, what happened was the industry took full-on advantage of the consumer. Even though product was tight, the markups were incredible. In fact, at the time, the U.S. Mint, I think by 2022, I think the cost from the authorized participant to buy silver eagles from the U.S. Mint was about $2.95 to $3.05 an ounce. Well, those authorized participants, some of them were buying it at $3.05 for example, and selling it at $20 over spot. They became ticket scalpers in a way. And as the prices of eagles went up because the mint was making fewer eagles, that lent to almost a taking advantage of other products, 1-ounce rounds, 100-ounce bars. It allowed the industry to start marking up those products exceptionally well, and to a point now where a lot of people that bought, say, when silver was at spot price of $30 or $35, they're barely breaking even now, even though silver's at 60. They may have paid a 10 or 12 or $14 premium to get into silver, but now the dealers are paying $8, $10, $12 under spot when the retail investor wants to sell back. And this is where the dichotomy of, and it's a bigger discussion I know David Morgan and I have all the time, is that a lot of dealers will say, well, the Chinese market, for example, is at a $10 premium to the silver market, $10 premium to the COMEX price. So that must be the real price of silver. Well, what's unfortunate is that they promote this silver as money mentality, but when the client goes back to sell that metal, it's treated like a teacup bought at Walmart. I mean, it's bought at a severe discount. So that's one of the issues, I think, why the retail public is just fed up. They're like, listen, it's easier for me to go into an ETF where I don't have these 20 and 30 and 40% spreads that I have to make up just to break even. I can just go right into an ETF and play the price action.
Well, if we take a look at where, let's say, gold and silver are now, I'm going to turn our attention now to the miners. And Dave, I'm going to go to you for this. If we take a look at where the price of silver is now, it's about $61. I take a look at where it was in the second quarter of last year, it was around 40. So even at $60, we're up almost 50% where we were a year ago. And Dave, you follow the silver miners, so do I. I'm looking at miners that are all in cost are $15 to $18 an ounce. And if you're selling the product for 60, I mean, that's incredible cash flow margin that you're seeing with the miners. Likewise with gold. Any thoughts there?
Oh, just reiterating some of what you said, Jim. I mean, it's rather frustrating because that's, kind of my bread and butter. And the reason, I've advocated everyone to buy real metal first. I don't think if you do that, you should be in this space. But if you want to use leverage, the best, most efficient way to do so is to buy the underlying mining shares. And historically, you're going to get about a 3x. In other words, if gold doubles, you're going to get sixfold in a gold stock or thereabouts. It's certainly going to do better than what the metal itself does. And as you explained, it really hasn't taken hold yet. I think there's a number of reasons for this, and I'm not trying to make excuses. I've been in these markets as long as you, probably a little longer, Jim. I guess we're about the same age. Regardless, gold usually moves first. We've seen that. It led the way up, and silver caught up in January. Institutions buy physical and gold and large cap producers. That's after the metal moves. And really today, it's more ETFs, as Bob explained, because you don't have the risk of a mining company. Silver is lags and it begins to outperform gold. It's only after investors become convinced that higher metal prices are sustainable does capital actually rotate aggressively into the silver producers and developers. And the market is saying very clearly that they don't believe this move. And looking at it from today's perspective versus where we were in January, we went up 70% in 1 month, and it's now been cut in half. Perhaps they're smart to wait. So I would say that don't give up on the miners. I think if you are underexposed to this area and you have new capital, I'd certainly do a serious look at the miners. And I'd also caution that it's going to take probably more patience than most people think it should. Regardless, I think we're going to see their day in the sun.
Let's talk about some of the long-term drivers of both precious metals, and that's de-dollarization. You've got China, which is accumulating gold, and they're using it in settlement and trade. Unlike the US market, if you have excess dollars, you could buy treasuries, you could buy stocks, you can buy real estate. China has a closed market, so they settle in gold. But I'm looking not only on de-dollarization, but also looking at the deficit. I'm looking at the debt clock right now. We're about $39.5 trillion. We're going to be over 40 trillion by the end of the year. The deficit this year could be over 2.1 trillion. We're spending almost 20 to 25% of tax revenues on paying interest. And so I've seen all kinds of predictions of where the metals are going. You got people like Pierre Lassonde thinks it's going north of 17,000. You got Jim Rickards who thinks it's going north of 20. But when we took a look at these long-term drivers, I think this is really what's driving the metals. Any thoughts?
Yeah, I would. China's an interesting story because if you look at their financial system and what they're trying to anchor their currency to or their system to, it's gold. Whereas in the US, we're trying to anchor our system to debt or US treasuries. And I think China has a much bigger impact in the gold market for that reason. Meaning, if you look at when the Middle East a war or conflict took off in March, something interesting happened, and this is one of the reasons why gold did not participate when the war kind of started to spread or the conflict spreaded, was that China stopped printing money. In fact, they started reducing their money supply. I think it was in April for a couple months. And that reduction of money supply, I think they did that on purpose to try to slow the economy down as energy prices were going through the roof, and so they wouldn't have any type of crippling effects, from inflation that way. Well, 2 weeks ago, they started printing money again. They started increasing their money supply, started doing more repos and so forth. And now you're seeing gold kind of bottom here. And I think now gold, the interesting thing is I think gold is starting to react back with the Chinese back in the market, trying to expand their money supply, because obviously they got to try and get out of the debts and out of the deflationary issues that they're running into, especially in the real estate market. So I think people need to focus more on China when it comes to gold, sort of their dynamics, if that kind of helps.
Dave, any comments?
No, I really can't add to that. I think that, just to put it as succinctly as possible, all fiat fails. We're near the end game. We're seeing a lot of proposals to revalue gold, and will that help? Really, it won't. I mean, if it's revalued to current prices, it's $1 trillion against a $40 trillion debt. If you go up to 20,000, you're going up a factor of 4 or 5, which puts you around 5 trillion. Yeah, that would help, but you're still 40 trillion in debt. Until you can balance the budget, none of these ideas are really going to work. What you have to do is live within your means, and obviously we can't. We've borrowed the difference for so long that it's become a natural state, which of course it's unnatural. So I don't, hold this to be other than a big reset coming of some way, shape, or form, probably moving from a cashless society into a digital-based economy on some move that will take place under the central bank umbrella.
It's amazing. We're talking about deficits of $2 trillion a year when the economy's growing. We got low unemployment. We're talking about 40 trillion. And the most amazing thing with this level of debt and what the Treasury, the Treasury's, I think it's close to 10 trillion that's rolling over this year. So the Treasury has taken 1.5% original issued debt. They're rolling it over at 4.5%. And add to that, I think in the final months of the year, the Treasury will need to raise another $1 trillion just to fund the deficit. But I don't hear anybody, this is an election year, I don't hear anybody talking about the debt. Is that just absolutely surprising?
And that's one thing that could force rates higher is that the amount of debt that the Treasury does have to sell into the market. I mean, we're looking, July is going to be a big issuance month. It traditionally is. This quarter, obviously, the government is on a different fiscal quarter or fiscal year than the normal calendar year. So these are all impacts that the Treasury is trying to find new buyers of debt, and that's where the stablecoin comes into play, is it is trying to find, as institutions and central banks back off of treasuries, they're looking to directly sell these treasuries to the retail public all over the world. And that's, I think, where some of the support for the stablecoin comes into play. I don't know if that's going to be effective, if it's going to be popular, but that's the U.S. strategy, and that's why looking at how these how the Chinese and the U.S. anchor their systems, I think that's important to understand how the gold market kind of moves and how it's supported. One interesting note that wasn't talked about when you were talking about silver and mining activity and production numbers. Silver peaked in production in 2016 when silver was in the teens. Even though the higher price that we see in silver today, it has not resulted in actually more production. So you look at this as a commodity that the price doesn't necessarily mean there's going to be more silver produced by the mining companies.
So, if we were looking forward, we've talked about a number of issues. We talked about industrial demand for silver. We talked about central bank accumulation of gold. If you were looking for a catalyst that would move the price of gold or silver in the next 6 to 12 months, either one of you, what do you think that would be?
I'll go first, I
Yeah,
guess.
yeah,
Uh,
go ahead.
I would look at what happened in the Shanghai market. I think what took place at the latter months of last year and into January of this year was an absolute demand from the Shanghai Metals Exchange, which is different than the Shanghai Futures Exchange. And it seemed to be, from the best information I could obtain, that physical metal was being taken from whatever source possible. I also think, on reflection, that a lot of that metal was probably stored somewhere or stockpiled in a warehouse for future solar panel development or whatever. I cannot prove that. So let me say that's conjecture. I'll admit that. But it looks as if that market has definitely cooled off. So there was a physical demand. And I actually said a few times on interviews that this is true price discovery because it was the commercial bar market, which is the silver market, was moving it at that time. So I think I'll throw that one out, Jim. Other than that, there's a lot of catalysts. I'll turn it over to Bob. But as far as physical demand, that would be one that I saw develop and I think could happen again.
Yeah, I agree with David. One of the things that moves the silver price is when the market gets too hedged or too short. And I think watching, certain, I happen to watch a lot of these technical factors in the market, whether it's, lease rates, borrowing fees, financing costs, carrying costs, that type of thing. And I think what could happen is as the market's gotten levered, this leverage is being unwound. People are coming in and playing the short side. You saw this back in 2022 when interest rates were starting to rise, and everyone and the playbook was, listen, the CFAs or CTAs, commodity trading advisors, were going to go into the futures market, short gold and silver, because that's the playbook. When interest rates go up, they say, listen, the metals go down. I think the issue here is if the real rate of interest does not rise, meaning even if interest rates rise, but the inflation rate starts to rise again, that could start attracting new money into this market, even though the narrative has been, well, rising interest rates and rising inflation is going to force the Fed to raise rates. Like you mentioned, Jim, how do you raise rates when your interest cost is already over $1 trillion? They're just going to add to the deficits, and this is the dilemma that they're stuck in at this point.
Yeah, I think they're going to have to do something like yield curve control or buying. We know that they're buying what, 40 billion a month as it is right now. When you look at this overall, I wonder comments from both of you. What I think most investors don't really understand, the commodity market, whether it's gold or silver, is so small in comparison to like the bond market, the global bond market, treasuries, or even the equity market. So when money flows in, whether it's an ETF or hedge funds or CTAs that are buying, you get these what I call NASA space launch moves in spikes in the metals. And that's been, gosh, as far as I've been following, it's a frequent occurrence in the metals market.
Jim,
Yeah,
I'll
and
pipe
oh,
in on that one and I'll give it to Bob. So I was just looking at the money market, and Tavi Costa did this, so I'll give him credit. But the market was like $5 trillion at the time. Now I think it's 6 or 7. But regardless, if you took 7 and you took 1% of that amount of money that's floating in more or less cash equivalents, That is $70 billion. Use 60 billion, which is what the price of silver is today. So what that means is 1% of the money that's just on the sidelines were put into silver. 1%, that's the entire annual silver market, refining, mining, and recycling. So that shows you how small the silver market is relative to just the money market accounts, let alone the bond market, the equity markets, private equity, ETFs, et cetera. But Bob, you can probably embellish that.
Well, yeah, and that's a great point. What I was going to say is imagine now the explosive nature of all these structured products and options. And when you're dealing with futures, you're dealing with leverage and you're dealing with a much larger notional value, meaning $100 invested in an option contract can control, $1,000 worth of silver. You may be 10x that number. So if you start to see prices move, what's happening is institutions can use even less money, gaining that leverage to go out and actually control more ounces. And that's where you start to see the moves start to get sort of the exponential. I mean, you start seeing that volatility ratio, like we saw the COMEX or the CME raising the margin requirements, because if you look at the volatility ratio, for example, you could chart this on VX SLV, which is the volatility ratio of SLV call options. It just exploded. Volatility exploded, and in order to control that, you have to somehow delever the market or make it less leveraged, to protect just the nature or the clearing members of that market. So that's where you could start to see the explosiveness again in the metals markets, just coming from this derivative action.
So a final question to both of you. Given what you see now, technicals, fundamentals, what would you be doing if you were a metals investor here? I'll go with you, Bob, first.
Sure. I'm like David. I learned from David a long time ago that the physical metal, I'm a big believer in the physical metal. Having it outside the financial system, directly held, I think is a key factor when we're looking at the leverage and we're looking at the totality of the system in general. The idea of owning physical metal, first and foremost, it's a protection against counterparty and systemic risk. That's one of the reasons why I own it. It's no one else's promise to pay when you hold it physically. I think that's how most people should be looking at this. And like David mentioned, if you're after that core part of your portfolio has enough physical, then obviously you can kind of roam around and look for other ideas. But I think the physical is the best way to play this. Held off leverage, meaning all these gyrations and moves are just noise. The longer term picture is what I think we need to focus on.
Dave?
Yeah, I always taught from the beginning you should have real metal first. And I did, as you maybe remember, Jim, the late great Jim Dines. He had a pretty good way of looking at the markets. And I put for my members the buying zone. The buying zone for silver for me was under 60 the ounce. And I actually bought, in full disclosure, I bought from Bob. I think I would wait. I think we're going to see this market go sideways through the summer. But I don't think you're going to get hurt buying $60 silver in the longer term. Gold, my buy point was under 4,000, which it hit briefly. Silver just went under 60 briefly. If you're just getting started, I don't think you want to fear those prices. Yes, they sound high. Yes, it's a multiple of 12 on silver from when, I started the Morgan report at $5 silver. Regardless, if you look at it versus the amount of money supply that has been increased from that time frame till now, you're basically buying the equivalent amount of paper versus the amount of metal that you did way back then. That's a concept I probably didn't explain clearly, but what I'm trying to say is that the metals have done their job. They've preserved your wealth. They haven't necessarily made you wealthy, but if you had that same amount in a banking account, you are really, really having a hard time.
All right. Well, as we close, beginning with you, Bob, tell people about Idaho Armored Vault and how they can find out more information.
Sure. I appreciate you having me on. Our website is goldsilvervault.com. We run a one of the largest private depositories in the country, store about $1.5 billion in assets. I also run, for full disclosure, a hedge fund in physical metals with weightings toward gold, silver, and platinum. And then also we do buy and sell metals for retail and also high net worth individuals and institutions as well.
And I might
also,
just
I'm sorry.
just might put out, you have some of the best prices I've seen out of all the dealers out there.
Sure, I appreciate it. Yeah, and then also I was going to mention, I also post on X, Profits Plus ID. So if people want to see more daily type information, I try to put out statistics and actionable information that, tends to try to explain what the market is doing or potentially anticipate what we could be looking at.
Dave?
Best place is themorganreport.com. There's a 3-step process. You get on the free newsletter. You can watch a couple documentaries. And if you're interested in a consultation or our behind the paywall service, it's available at step 3.
Listen, I want to thank both of you for joining us on the program and clarifying a lot of, I guess, disinformation that's out there in the metals market. And compliments to both of you on doing that. All the best, gentlemen, and come back again.
Thank you, Jim.
To speak with our financial planning and wealth management team, visit us on our website, financialsensewealth.com. If you aren't already a subscriber to our weekday podcast and would like to listen to more of our content throughout the week, go to Financial Sense and hit the subscribe button.